Australians are regaining their love affair with shares, according to the latest survey of share ownership from the Australian Securities Exchange. In 2010, 43% of Australians owned shares, reversing a downward trend which began well before the upheaval caused by the global financial crisis. Andrew Robertson reports.
The share market has had a bumpy ride over the last few years. Confidence is slowly coming back though, but the global financial crisis has changed people's attitudes.
Most direct share owners are more actively involved in terms of managing their own portfolios. We can see that happening. We've got much less delegation and preparedness to just leave it to somebody else.
Government asset sales and a string of large demutualisation saw Australia become the world leader in share ownership, peaking at 55% of the population in 2004. That figure fell by a quarter over the next 4 years, but in the latest survey the trend has been stopped, with share ownership rising slightly to 43%. Direct share ownership, which excludes managed funds, is also up from 36% in 2008 to 39% last year, but still down on 2004. Managed funds are at their smallest proportion since the study began in 1999 at just 4% of total share ownership and only a third of what they were 6 years ago. Financial planner Louise Lateline says she's not surprised.
Quite a few managed funds closed during the financial crisis. For example, mortgage funds, some of the fixed interest funds. And what that meant is that clients, even if they had $10,000, doesn't matter how much money invested, they couldn't sell down that asset and get access to the cash.
At nearly $14,500, the average share trade has hardly changed in the last 4 years, while the average share portfolio, thanks to the GFC, is well down on the peak of 2006. Investors are also trading more often and holding their shares for shorter periods of time.
It's probably a natural transition when we can see a lot of people that did have their portfolios dramatically reduced as a result of the GFC, that there's going to be more of a shorter-term focus on or a closer scrutiny on how their portfolio is performing.
Financial planners are now clearly the leading providers of advice for people investing in the stock market. Louise Lateline thinks that's another result of the damage inflicted by the global financial crisis.
I think financial planners, because they're across so many areas of a client's position, that over time they become more trusted and gradually have become the option for clients in looking at where their investments go.
However, when it comes to trading, 42% of share investors use online brokers. The ASX survey did throw up some surprises though. Corporate governance and corporate social responsibility have declined in importance for share investors, despite both being hot-button issues in the current corporate environment. Leeora from the Centre for Corporate Social Responsibility in Melbourne thinks the ASX study doesn't represent the true picture.
It's a huge shift in thinking that's required of people to think about corporate social responsibility. It's a complex concept. There's not a lot of agreement about what it really means. Different people and different organisations will interpret it differently. And as an emerging concept, I think that that's to be expected.
Dr Black says the challenge from the ASX results is to persuade small investors to take qualitative issues into account before they invest.
If the institutional investors and the companies can demonstrate that they can bring value through a greater focus on social and environmental factors, then the consumers or retail investors will follow and they will support it, but they're unlikely to lead.
As for the fall in importance of corporate governance, Sandra Boyd-Hoare believes that's because 82% of people are happy with the way the Australian share market is regulated.